2018 has been a year of record highs for stock markets, but the party, it appears, can't last forever. And this week, the hangover appears to be setting in. After yesterday's scary sell-off, Wall Street and Bay Street were again awash in red ink. In Toronto, the TSX lost 200 points, hitting a 6-month low. In the U.S., the Dow plunged more than 500 points, and that adds up to a nearly 1,400-point loss in 2 days. The Nasdaq briefly entered a correction today. That means it was at 1 point down 10% from its recent high. So what's driving this scary sell-off? U.S. President Trump blames the central bank for raising interest rates too quickly. Take a listen.
We have interest rates going up at a clip that's much faster than certainly a lot of people, including myself, would have anticipated. I think the Fed is out of control. I think what they're doing is wrong. I think the Fed is far too stringent, and they're making a mistake, and it's not right. And it's, despite that, we're doing very well, but it's not necessary, in my opinion, and I think I know about it better than they do.
Meanwhile, in other economic news, the federal government announced today it is slapping tariffs on steel imports from all countries. The tariffs of 25% will be applied to 7 types of steel products coming across the Canadian border. The feds call them safeguards because they're aimed at staving off a potential increase in imports of steel products from countries shut out of the American market. The Mexican government is speaking out against Canada after this news in saying a few things. First of all, says that they'll use all mechanisms available under NAFTA and the WTO to achieve its total exclusion from Canada's trade safeguards. Basically saying that they're going to use every tool in their toolbox in order to fight the safeguards. They said that they were disappointed, that they're carefully going to review them, and again, that it might take the matter to the WTO. So we're going to head back to the issue we first were speaking about, the volatile stock markets. Why are higher U.S. interest rates, as President Trump said, spooking investors, or are they at all? Are there other factors at play? And what should Canadians do with their investments? Bill Robson is President and Chief Executive Officer of the C.D. Howe Institute, and Brett Howe is Scotiabank's Deputy Chief Economist. They join me now from Toronto. Hi to both of you. Thank you so much for being with us. Really appreciate it.
Pleasure. Thanks. Good evening.
Mr. House, I'm going to start with you. Your general read, I guess, on what's happening with the markets right now.
Well, I think there are 2 things that are happening. You know, share prices reflect an estimate of what the future value of earnings produced by companies is likely to be. And as fears have increased that the Fed is going to move interest rates higher, there's concern that those earnings projections are maybe going to come in a little lower than people have priced to this point. So that's one factor that has been pulling down prices. The other factor is the uncertain, unpredictable, and illogical trade policy coming from Washington, which is creating frictions in global trade and potentially dampening growth as well. So those 2 factors, I think, are coming together to put pressure on share prices right now.
Mr. Robson, your read?
Yeah, certainly interest rates increases are part of it. I think people have been anticipating this for a long time, that interest rates would go back to what we would have once, or closer to what we would have once seen as normal levels. But then once it starts to happen, it's quite unnerving. The reassuring thing is that we're talking about a reset of interest rates if the Fed were to raise short-term interest rates and bond yields went up a little bit from where they are. It's a one-time level shift, so it doesn't imply that the market would continue to go down. But keying off Brett's comment just now, and I'll also add Donald Trump attacking the Fed. I mean, these policy moves, this kind of volatility, this kind of uncertainty, and some potentially damaging stuff, unfortunately the downside is harder to call. So on interest rates, I'd say a level adjustment, and then we go up from there. The policy stuff does make me more nervous.
Mr. Robson, let me follow up on that and just ask, how significant or how unique is it that the president would call out the Fed?
It's pretty significant. This kind of unrestrained language, of course, we're used to it from Donald Trump, but when you think about past criticisms of monetary policy, this is over a number of lines. And it's got to be unnerving, because one of the big successes of economic policy, and one of the things that in fact has allowed the U.S. government to borrow as much as it has, is this confidence that you've got an independent central bank that's going to hold the line on inflation. So I don't see anything happening in the very short run. I don't see the dam breaking. But to have the president talking this way is bound to raise people's concerns about the central bank over the longer term. It's an unnerving thing, and you don't like to see that.
Speaking of unnerving, Mr. House, let me ask you about investors who are watching right now and have been watching kind of with clenched teeth for the past few days. What is your advice to them?
Well, yeah, as an economist, I'm really here to describe what's going on in the economy as a whole. I'm not a strategist on asset prices, but what we do know from the academic literature and a whole host of studies is that trying to time movements in and out of asset classes or markets generally doesn't work very well. So if you're an investor who needs cash in the short term, either to pay bills, put a down payment on a house, or pay tuition, you probably shouldn't have been in shares to begin with because they're just too volatile for those short-term cash needs. If you're a longer-term investor where you're putting money away for your retirement, don't look at your statements, don't look online, don't look at what the indices are doing. Just keep putting money away and look at it in 30 years when you retire.
And Mr. House, when you're looking forward and trying to determine, and you sort of touched on this already, but trying to determine where the markets head next, what factors are you taking into account?
Well, we interpret the rate increases that are being anticipated by the Federal Reserve, and it should be said the Bank of Canada, as a sign of confidence in the two economies rather than a note of fear that earnings or growth are going to be lower. Both central banks have been moving far more gradually than they would in usual hiking cycles. They're raising rates and testing to see what the impact is. They are very data dependent, as both central banks keep saying. And to us, that's the kind of policy stance that's likely to elongate the expansion rather than bring it to a close, because it ensures that the central bank doesn't have to jack rates up higher than they might otherwise have to do to try to control breakaway inflation. This is really growth consistent, and we think at some point the markets are going to take that message to heart.
In layman's terms, what does that mean? That this is not going to be a sustained downward trend?
Yeah, that's our view, that there's a bit of a reconsideration of what are already very high prices on many equities, and that they are going to see a point where they look at the underlying fundamentals of the major economies, which remain broadly strong, a kind of Goldilocks, where it's not too hot, it's not too cold, it's kind of like porridge, just right. It's not spectacular, it's not knocking your socks off, but as Jerome Powell, the chair of the Fed Board of Governors, said, it's almost too good to be true. This is kind of a sweet spot. And I think views will shift and return to that notion.
Mr. Robson, what are the sort of broader implications for the Canadian economy of higher interest rates?
Well, in a sense, we are getting back to something that looks a bit more normal after this emergency level of interest rates that we've been seeing for the last decade after the financial crisis. So for a lot of people who've never seen interest rates higher than these emergency levels, it might be a little unnerving. But as I was saying earlier, and I think Brett is in the same place on this, that with no inflationary blowout, you're not looking at any kind of radical increase in interest rates. And so things might cost 1% a year more, but it's not going to be a very wrenching thing for the average consumer. I do think for governments that have been used to borrowing at such low yields and sort of justifying loading up on debt with rates as low as they are, this will be an opportunity to sort of reconsider where they're going with that, because this is the point in the cycle when we should be seeing budget surpluses, not all this additional borrowing.
Yeah, Mr. House, let me get you on that too, yeah.
Yeah, there's a really important thing to remember here. The rate of inflation in both Canada and the United States right now is still at or higher than the interest rates that central banks are charging as their baseline rate. So what that essentially means is you are still in a situation where if you're one of the best borrowers, you're nearly getting paid to take out loans because the cost of things, that in the economy more generally is advancing more quickly or at a faster rate than the cost of your loan. So,
and when does that change? When inflation comes, when the gap gets closer?
Well, either inflation has to come down or those policy rates have to go up. And they would have to go up substantially from where we are right now, even to get to a situation where it starts costing you to take out a loan at those benchmark policy rates. So we're still in a situation where the central banks are providing a lot of support to our two economies.
And Mr. Robson, just to pick up on the point you were making about the federal government, there's a fall economic statement coming. What are you looking for in relation to what you just said?
Well, I'm certainly hoping that we'll see some response to the competitive pressure we're under now with the United States tax reforms. I think that the federal government does need to partly signal, but also do something substantive in order to avoid what now looks like a very strong inducement to locate your capital investments south of the border. There's a standard desire among a lot of people, including me, to see them show some kind of path towards balance. This sort of casual attitude about the bottom line. The borrowing amounts aren't alarming in and of themselves. And Brett makes a good point about how sustainable it is if interest rates are still at a very low level. The difficulty is that at this point in the cycle, you really ought to be running surpluses, and we don't want to see a flow of red ink. I will mention one more thing, because I know a lot of people, here we are talking about the market correction as something that's likely transitory, buying opportunity and so on. I hope that's true. But for people, especially people who are well on in years, who are seeing the value of their assets drop, there's one thing I'd like to see Bill Morneau do, and that's those people who are being forced to draw their assets down in retirement if you're in a RIF. A market correction like this is a very toxic thing for an older person who can't save anymore. I think they should provide a little extra room for people to hold on to their wealth instead of forcing them to draw it down. That's something that would be really nice, especially for people who are on the wrong side of this market correction.
Okay, I'm out of time, so I have to leave it there, but I really appreciate both your perspectives. Thank you so much.
Thank you.
To Bill Robson and Brett Howe.